think there's maybe a three-pronged series of events going on. Number one is the global slowdown that you were just discussing with Stacey and the uncertainty around the trade war. Will the president move to put more tariffs on the remaining $300 billion of Chinese goods that come to the United States? And we saw very soft Chinese manufacturing data out this morning, lowest or slowest pace, we should say, since 2002. So with that pullback, that affected Asian markets. And there's been a flight to safety, broadly speaking, in bonds of all kinds, whether they're here at home or whether they're in Germany, now yielding nearly a negative 0.25%.
Yeah.
I think part of this is geopolitical as well, with the Iranian tensions heating up. Gold would not be going up with bond yields falling if this were an inflation scare. This is a different kind of scare.
All right. So, Valerie, you're positioned how for that then? Do you say, hey, stay long stocks, we'll work our way out of this, or no?
Well, our perspective on the equity markets is that the market is actually neutral to positive. We still see opportunities in the market. Currently, we are overweight consumer discretionary as well as consumer staples.
So you probably felt good about the retail sales number this morning.
I felt very good about the retail sales number this morning. And that's why I think it's very important not to overestimate or overinvest based on short-term fluctuations, because we know that some of these economic indicators really can vary, and then they're subject to restatement, as was the case for last month's retail sales figures.
What would change your positive view on stocks? What would it take?
It would take sustained evidence of a slowdown in the U.S. economy, because what we know is that with global trade, the economies are much more interdependent. We tend to invest in large cap equities, which means that these are multinational companies, right? So it really matters what's happening with trade. The macroeconomic environment can have some unintended consequences.
But what about the people who say, I don't want to wait for that slowdown to show up? I want to get out now. I mean, we've seen that for a decade now. People are so quick to jump out because they go, I don't want to take it down 40% again.
Right. But we know that it really pays over the long term to stay invested, particularly in equities. Our outlook is for about a 6% long-term return coming from the equity markets based on our expectations for corporate profits, as well as probably about a 2% dividend yield in the market, again, over the long term. So I advise people to stick with your asset allocation and stay exposed to equities.
I was just say very quickly, one thing that people are not pricing in is a sideways market for an extended period of time. If you look at where we are right now,
way up or way down.
We're where we were in January at the highs of last year. We're 3% off those highs that we've now hit 3 times in about 15 months. And we've had periods where the market slammed between a couple of levels for an extended period of time until certain developments resolve themselves, whether it's geopolitical risk, whether it's concerns about a growth recession or a profits recession. Those are the things that appear to be on people's minds right now. And so as much as the market's only 3% from its high, it's also really not done much in the last several weeks, months, and even in the last 15 months. And so we're really no better off than we were in January of 18. Got a lot of sound and fury, if you will, maybe signifying nothing, maybe signifying something.